Hello, my name is Kevin, part of the Market Insights team based in Toronto, Canada. Today is Friday, August 1st. It's 4:30 p.m. Markets have closed. Equity indices in the red. The dollar giving up its weekly gains and starting the month 1% down. Actually, it's incredible how sentiment can flip so quickly. And my attempt with this webinar or throughout this webinar is going to just try to bring them major macro themes. But I'd say most importantly, it's just kind of like recap last week, which has shaped month end and the month of July. And it's going to set the tone for what's going to happen in August and probably throughout the third quarter. So yeah, so I'll just jump into it, and I'll start with the US dollar and just a brief view of what has happened beginning last weekend actually with the US policy. So the US and the European Union signed, or not signed, but agreed on a deal setting the tariff rate on all exports from the European Union to US on a 15%. More details added to the trade deal, to the package. But in general, after the weekend, markets start to wake up to the news and chew on a little bit of the information and see that this deal or trade agreement is more of a win-lose, win for the US, a lose for the European Union, which seemed to give the US administration lots of concessions to avoid steeper tariff rate. So after this, what happened was the US dollar gain, but most importantly, the euro to start the week just dropped and accumulated throughout the week until yesterday, a drop of 3%. Incredible that we were entering July and markets were eyeing the euro towards 120. We started the month thinking that the US dollar soft patch was going to continue. However, because of this ease of trade tensions, the agreement of bilateral trades with the most important trading partners, the European Union, South Korea, Japan, then markets just reached month end with a very upbeat sentiment and momentum, US equity indices reaching all-time highs. And that was throughout the week, the euro and pound bleeding and not finding support through 114, 113 levels for the euro. We had then throughout the week, midweek, the Federal Reserve and the press conference with Jerome Powell sending a very hawkish message, and Jerome Powell seemed unfazed by the dissents of within the FOMC, the Fed committee in Wednesday that showed that for the first time in 30 years, two governors dissented and are asking, aligning with the US administration, are asking for rate cuts. They're known, markets were expecting this, but what the markets were not expecting was this hawkish message from Powell, and just saying that the rate hikes were actually in consideration from some of the committee members, because the latest CPI readings are starting to show some of that tariff inflation. And of course, the Fed's dual mandate is stable employment and lower inflation, or closer to 2%. On the employment side, we'll talk about that later, but on the inflation side, which is where it seems Powell, he seems so committed to definitely bring that one to below or at 2% after being just a couple of years ago about 8 and speaking at 9%. And definitely there's been progress, but Powell leaving in 2026, he doesn't want to leave as the Fed who didn't finish the job. So he, after five straight meetings, the Fed has hold rates at between the at 4.5%, 4.25% range, and the message is clear. They'll stay data dependent, no forward guidance, no clarity, because even though there's some impact on inflation on the CPI, the data is not clear enough for the Fed to actually resume its easing policy, and it's now a very tricky, difficult position. So after that meeting and some other macro data that was upbeat, advanced Q2 GDP in the US higher than expected, although under the hood softer. ADP private job report on Wednesday was higher than expected as well. A core PCE, which is the Fed's preferred measure of inflation, it was higher than expected. So all things considered, was giving the Fed aligning all the macro data with Fed's view that the data is solid enough to not cut rates. And it's crazy that just yesterday markets were expecting the Fed to hold with a probability of closer to 70% on the next meeting on September 17th. But on Thursday, and just ending Thursday, then we have the latest update on US trade policy, which is an update of the Liberation Day reciprocal tariffs that were released or published by the White House in April 2nd. So they were basically published and just setting a baseline rate tariff of 10% across the globe. Markets didn't take it positively, but definitely the tariff story has been, markets have been pivoting away from it, because now what the markets are expecting is the economic consequences of this US trade policy. We've been waiting to see more of these impact in inflation from tariffs or from this new tariff regime that actually just starting today, we are having a clearer picture. But then today, the payrolls report, the job report in the US, a really bad report, not solid report, and just showing that the economy in the US is not doing as great as markets were expecting. And again, the sentiment flipped really quickly after the report. The odds of a rate cut by September increased to close to 80%. The dollar dropped sharply 1% today, and equity indices as well. So getting into the data itself and the job report, was expected for the economy in July to create 104,000 jobs. The economy created only 74,000. Now, out of these 74,000, the jobs or the sectors that are creating these jobs are healthcare and education. And not that these are not important sectors, it's just that these are low productivity sectors. And if you strip those sectors away from the reading over the last 3 months, the economy has been actually shedding jobs, manufacturing, other services in general. The private sector has hit a wall in terms of job creation. And on top of this, the revisions for the last 2 months were revised downward and shedding basically 250 jobs out of these last two months reports. So just making this last report much weaker. And definitely the cracks are now much more evident in the labor market, and the biggest threat, and I'll dive into it in just the next slide and a couple of slides, to the US dollar now is the challenge around the soft landing narrative, which has been holding for now 3 years, cause of a recession, not over the last 3 years by economists, analysts, CEOs, everyone basically expecting for a recession in the US economy, but everyone's been talking about the resilience of the economy, US exceptionalism, equity indices, the AI boom, and just data after data point, month after month. We haven't seen any cracks, I think, just until today. And that's why this is so important, because this is going to set the tone for what's going to happen throughout the second quarter. We don't have the Fed meeting until September, although Jay Powell is going to speak in the Jackson Hole Symposium by mid-August, and we'll see what the macro data will bring up to that point. But definitely, this data point alone is showing that the labor market is not doing great. So the Fed is now in this tough position of a cooling job market, much more clear now, but then all this uncertainty about tariff-induced inflation. And it is expected that the CPI readings for the months of August, September, and October will see a goods inflation increasing, especially in those sectors that are more sensitive, as we've seen already in the last CPI report. So you see this flip in sentiment is so quickly, so sharp, and definitely a challenge to the soft narrative landing is now the biggest threat to the US dollar for the second half of the year. So I'll just go quickly through these key insights for each of the regions. For the European Union, as I mentioned before, the euro was certainly due a rest following the best 6-month run since 2003. For the pound, starting the month, last month, hit its highest level versus the dollar since October 2021. But it quickly retreated, and it has slided over 3% and breaking below its 2025 uptrend as there was more demand on US dollar just until today. Aussie suffered its biggest monthly decline in a year, but the pair is just trading really sideways in the stack range between 0.63, 0.65, and 3% above its year-to-date average. So, what are the key market themes to watch these next month? And probably these themes will stand for the throughout the third quarter of this year. The tariff story. Again, we're seeing that the headlines are not having such an impact on the markets as we saw previously back in April, May, because now we're faced with the economic consequences of this new tariff regime. So the U.S. administration and the White House released the update on the reciprocal tariffs, setting a baseline tariff rate across the globe at 10%. And you saw a few surprises there with Switzerland, for example, at 39%. No deal reached with Canada, top 5 trading partner. Mexico reached an extension, at least, or a pause for the next 90 days. So you see all the mess that the tariffs have created so far, and many people keep asking, well, why tariffs? Of course, one of the major reasons for tariffs it's much more clear now. It wasn't back in the beginning of the year. It's going to help increase revenues to support the tax reform that it's expecting to increase the fiscal deficit in the US for the next 5 to 10 years. So it is not just about trading balances or the fentanyl in between with Canada or Mexico or even China. There are political factors. You see the tariffs with Brazil, for example, mainly politically motivated. So you see these different reasons, but definitely the revenue will be a key one as markets try to understand and digest a little bit of what's going to happen between growth and fiscal expansion as this tax reform has extended Trump's cuts from 2017 all the way now through his second term. And then there's the other major macro theme, which is people have been asking throughout this year, markets, investors, analysts, are we seeing the end of U.S. exceptionalism? And probably not so fast. We are in the midst of the second quarter earnings seasons in the U.S. And this week, 4 of the Magnificent Seven reported earnings. Most of them beating expectations, but the key theme there is that they keep increasing their capital expenditure in AI. So the AI theme, it's still the theme that's been driving not only the indices but this concentration within the Mag 7 that's driving sentiment as well in the markets. So the markets are expecting that this robustness of AI and the AI theme to spread throughout the economy. But now you're seeing like different aspects of the economy. Private sector not doing so well, housing at a standstill, and the AI theme is just booming. You see Meta, for example, trying to poach AI talent from different companies and luring them with athlete type salaries. And you see that this economy around AI is increasing and increasing. But at the same time, for example, Microsoft has said that they are slashing jobs on different sectors. So definitely different themes that are on one side are bringing wealth to some, those that are investing in the markets, those who are investing and they have the disposable income to invest in markets. But then you have these other sectors of the economy that are struggling. Manufacturing, for example. We've talked so much about manufacturing, and all one of the reasons behind this trade policy from the US is exactly to bring back manufacturing jobs, to incentivize investment in the US. But so far, as many have expected or are expecting, the inflation to tariffs to hit inflation and growth to stall as well. Well, many are expecting when will we see manufacturing and other sectors in the economy benefiting from these tariffs? Well, not so much, right? So these definitely are themes, macro themes, market themes that are intertwined and definitely will keep shaping sentiment in markets for the next month. And then in terms of seasonality and what could we expect for FX, usually August it's a volatile month. However, when we see that the US dollar is coming from a soft patch and the month before August has increased, as it was the case this last month, then August tends to be not so volatile. So we'll see. For now, volatility is there. Just one day of this month, and definitely because of the flood of information and the impact and the magnitude of this information is definitely just set the tone for what will happen, and we're definitely expecting volatility for the month of August. So, and the other question that many have been asking over the last couple of months, or at least the last couple of weeks, is: are we seeing a, a a bottom in the U.S. dollar? Are we is the worst for the U.S. dollar behind us? And I have to take you back to what one of the market narratives back in April and May, the sell American narrative, which was okay because of the trade war and the fiscal policy and the U.S. losing its credit rating to Moody's back in May. Then, well, investors, institutional investors, everyone is just flying away from the U.S., but in a way that it wasn't just so like dramatic or fast, but kind of like in a slow pace, right? And that was the narrative back then, back in May, peak tariff uncertainty when markets tanked. But we have the data now, and the data it's showing actually the exact opposite. In May, investors, private investors, institutional investors, they went hands deep into US denominated assets. And they are part of the reason that the markets have bounced so fast, so sharp in May. And that's why we're seeing the US equity markets hitting new all-time highs to end July. What's the biggest reason then behind the US dollar losing about 8% throughout the year and having its worst start to a year on record so far? I'd say that one of the most important reasons is hedging. When fund managers, institutional investors, they are thinking about their allocations, what they do first is they hedge before tactically reallocating, right? And we as again, the data is not showing that reallocation away from US, but actually that because of the volatility and the uncertainty, it's likely that many institutional investors, insurance companies in Asia, fund managers and pension plans in Canada, major trading partners or major economies, basically hedging, and the selling forward has put a massive pressure on the US dollar. So now, what are we left now, given that we're not speaking about the same levels of volatility? Well, we're seeing that if you're just thinking about the macro data or the fundamentals, then what are the alternatives away from the US? And we have the euro, but markets are focused now on the US euro trade deal, which is posing to be not so great for the economy. And what about Japan? Well, they have their own issues with inflation, new cabinet, politics turmoil a little bit in there as well, and worries about spiraling inflation, as well as a spike in long-term yields in Japan. What about the pound? Similar issue with the European Union as well. Then the question is, what is the major threat then for the US dollar? Is the challenge of the soft landing narrative. If we see that this is not a soft landing, but a hard landing, amplified by this new tariff regime, definitely the US dollar will feel it, as we're seeing today, 1.3% drop to start the month. This is clearly an indicator that if the economy is not in a solid shape. Markets are now expecting for the Fed to cut, but Powell will stay focused on inflation. And then if we're approaching a stagflationary space in the US, then that is worst case scenario for banks, for financial system, for central bank, for the US dollar as well. So this is the theme now, and this will be the theme in focus for the month of August. So we'll definitely be keeping an eye on it. And definitely the most important is that macro will be leading the way all the way till the next Fed meeting, which will be in September 17. Throughout August, again, a few central banks will meet. For example, the Bank of England next week, which is expected to cut, and a few other central banks in Asia, Asia Pacific. But again, most important will be CPI readings, PPI readings. So you'll see in manufacturing services, all the data points that are key and important to assess the health of the US economy. And this balance between growth and inflation is our tariffs are hitting retailers, big companies. Are they eating the tariffs? Is the tariff pass through faster? Will be gradually and slow? All these will be assessed by markets throughout these next couple of months. And now let's talk about FX. So let's try to just bring these all down to FX, of course. And again, a little bit of what happened in July was starting July, we thought, yeah, we'll continue. The dollar will continue with its soft patch. The euro is targeting the 120, the pound closer to the 137, 38, maybe even the 140. The Canadian dollar just below 135. So just this continuation of a US dollar softness. However, as we went through July, the easing of US of trade tensions and upbeat macro data supported the dollar, and in particular for the euro, this trade deal was weighed heavily on it, which saw it just give up lots of its yearly gains. Trading range, and speaking just of volatility, the Japanese yen and the Kiwi saw increased volatility throughout July. But where you're seeing that the most volatile currencies throughout the year have been the Swiss franc, the euro, the Mexican peso, and the Japanese yen. So what is the Mexican peso doing in the mix, in this mix? Well, another major story throughout this year, of course, has been this high demand of high carry emerging market currencies, LATAM currencies, that have been benefiting from these kind of like Goldilocks type of market sentiment, where like risk mode is on. Market investors are trying to invest in high yield because the sentiment is there, so they're looking for local debt in emerging market assets, where the yield is high, and that's where you see the Mexican peso, the Brazilian real as well, the Mexico, the target rate set by the central bank is at 8%, in Brazil at 15%, Colombia 9.25%. So that's why you're seeing these currencies performing so well, along with, again, the softness in the US dollar. So again, volatility, it's been the name in effects throughout these last months, and throughout, of course, the year because of the US dollar soft patch. In terms of value, and just checking this global FX value indicator, you see that the euro and the pound are still way above their long-term long-term averages. So still solid gains, and many are thinking, well, yeah, the euro was due for a just a pause after just a spectacular year, its best 6 month performance since 2003, of course, similar for the pound as well. And the euro against other crosses as well, having really great performance, for example, against the CAD as well, just way above its long-term and short-term averages. North America, speaking of the Canadian dollar, just very close, very tight to the short and medium term average, 2 year average, just right at 137.6, which is very close to today's actually close. And the Mexican peso behaving actually really well again, just shy of its 2 year average, but still probably some and yeah, again, the room for the Mexican peso to keep gaining will depend on US dollar's fate for the second half of the year, and volatility, of course, which is the case for the Swiss franc as well, and the commodity or the antipodian currencies, Aussie and Kiwi, which are trading below their long-term moving averages. I'll quickly review the future scenarios for the pound and other currencies. Well, I'll just focus on the central scenario. And again, the Bank of England is meeting next week, and the markets are expecting for the Bank of England to cut rates, which probably markets have priced in this already. But you're seeing that the base case scenario is showing these trade range between 132, 133 to 139, 140 to end the year, and expected to end the year closer to 136. What are the major factors around or that are shaping the central scenario? Well, the narrowing of UK-US economic growth divergence in the wake of US tariffs, and the probability of a lower growth helping support sterling's long-term outlook. That's kind of like the base case as of now, and confidence in safe haven US dollar also eroded due to not just US policy risk, but because of this challenge, of course, of the soft landing narrative. So we saw the pound dropping all the way to 133, 132, closer to that lower band, the lower side band of that range, but just bouncing back closer to 134 to end the week. For the euro, again, the expectation for many is that the softness will prevail in the US, which will give gains to the euro, the most liquid alternative, and will just send it to 120. However, it might be stretched as of now, the balance of growth expectations between the US and the euro. It is now, because of the payrolls data, stable now, and we might see it just finding consolidation in the 115 area. The European Central Bank, as of now, it is not expected to cut rates, but if there's a rate cut from the European Central Bank, and there aren't any rate cuts by the Fed, then that's where you see a challenge to this expectation of the euro reaching to its to 120. Yield differentials, they haven't been explaining much of the price movement throughout the year. It's been you could say mostly sentiment, but again, because of how quickly sentiment and narratives flip and change, you could see this again giving euro another boost again to start the month, starting next week. The Aussie trading a tight range, but you see that the base case it's kind of like trending upwards because the expectation is for the Australian economy to stall and to kind of like follow what will happen with China, with other major Asian trading partners, and because of the tariffs and global growth decreasing, commodity prices decreasing as well, then weighing on the Aussie. So 0.64, 0.67, and we'll see what will happen with the Royal Bank of Australia, which may hold in the coming steady in the coming meetings, but if U.S. rates stay above Australian rates, they'll of course cap growth for the Aussie. Similar macro backdrop for the Kiwi, although the New Zealand is facing a steeper tariffs than expected, and of course negotiations are ongoing, and now between New Zealand and the US, they will expect to get that tariff rate closer to 10%, which is the baseline tariff rate. But again, a slowdown in growth means a slowdown in slower commodity prices, and just keep putting under pressure to the Kiwi. 0.60, 0.68, the range for the next month, to end the year closer to 0.59, 0.61 trading range. For the yuan, again, manufacturing is key. The real estate sector is key as well. And all the recent supportive action, fiscal supportive action to support the local economy, which is as of now unprecedented. From the Chinese point of view, what they are seeing is that they are actually winning the trading war, the trade war, because they were expecting to shed some manufacturing jobs because of automation, and these tariffs, 30% tariffs, they definitely won't deter much the ruling party to continue their fiscal and economic policy. They're mostly worried about the personal or the local demand, and the local economy is not responding to the recent stimuli as expected. So we'll see what will happen if the Fed starts cutting rates by 25 basis points in September, and just gives some support to the yuan as well. You see the base case scenario there, 719, 727 to end the year. Singaporean dollar as well. Global trade is likely disappointing as Chinese growth remains sluggish, keeping the Singaporean dollar near recent highs. And for the CAD, the Canadian government didn't reach a deal before today's trade deadline. It was expected that Canada and Taiwan were going to be the only major trading partners not securing a trade deal, and so the conversations are ongoing. But probably what will happen in Canada is the government will have to send the message locally that there'll be a level of tariffs that will have to that the economy will have to live with. And what is the good news though is that the COSMA or USMCA trade deal is shielding part of the trade. The Bank of Canada is in their own projections are expecting for goods to be shielded by the COSMA deal, to be the share of goods that are shielded by the COSMA deal to go from 50-60% to all the way to 90%. But that might take time. And with the tariff rate now increasing as of today from 25 to 35%, that'll definitely just weigh on the economy, which is the expectation is that the growth will keep just sluggish, and the problem as well, similar to border south, is that inflation and tariffs keep weighing on inflation. Similar story in Canada. Sticky inflation, core measures of inflation above 3%. That's why markets are now expecting the Bank of Canada to cut rates in September 17 as well. So trading range 137, 140 probably, but you see the expectation of the trading range is likely to be between 136 to 139 to end the year. And for the Mexican peso as well, it will basically mostly rely on global sentiment. If there's low volatility, the dollar remains soft, and Banxico cut rates at a slower pace, which markets are expecting. Of course, a little bit of carry erosion, but then again, the peso will keep benefiting if the dollar soft condition remains. In terms of considerations for global businesses, because of the macro environment we're living in, there's a lot of volatility, and that has prompted many businesses to reconsider their risk management strategies. So just feel free to reach to us, to talk to us. So we have a full range of currency risk management tools that can help weather a little bit of the storm and uncertainty around these certain pairs, majors, exotics. Definitely, we have the tools for it. In terms of diversification, we have the solutions that can help organizations accelerate payment speed and diversify into alternative markets. And efficiency and security, of course, we have automated global payment solutions, compliance controls, and fraud prevention measures to help you to be more efficient and enhance your payment process as we go through the third quarter of 2025. That is it from me. As always, thank you very much, and feel free to reach out to any of the Market Insights team. We're always happy to help provide market color. And as we go through these unprecedented times, we'll just keep uncovering what's going on in markets, how markets are reading and processing all this information, and we'll just bring the best insights for you for the next few weeks and months. Again, thank you very much, and have a great August. Bye-bye.